Whitecap Resources Inc. (WCP) is strategically positioned as a premier Canadian exploration and production (E&P) company, successfully transitioning toward a larger scale of operations achieved through recent accretive strategic mergers and acquisitions (M&A), notably the integration of the Varen assets. The central investment thesis maintains that this elevated scale is unlocking superior capital efficiency, enabling WCP to generate large volumes of predictable free funds flow (FFF). Management's consistent track record strongly supports this thesis, evidenced by historical success in achieving a compound annual growth rate (CAGR) of 12% in funds flow per share, 11% in production per share, and 13% in total proved plus probable reserves per share, validating their growth discipline. The next 12 to 18 months present three key catalysts expected to drive a significant re-rating of WCP's equity valuation. First, the realization of the full annual synergy target, which management has proactively raised to $300 million, is crucial for validating the M&A strategy and embedding permanent structural margin expansion across the enterprise. Second, the company's ability to achieve the ambitious 2026 target of $1.2 billion in FFF is essential, especially since this target is based on a conservative base case assumption of $60 per barrel WTI crude oil prices. Third, successful execution of the clearly defined shareholder return framework, including the deployment of the $300 million normal course issuer bid, targeting approximately 2% of outstanding shares, alongside the consistent sustainability of the established $0.73 per share annual dividend, will demonstrate financial discipline and enhance per share metrics. 1.2. Financial strength and value proposition. WCP exhibits exceptional financial resilience, a cornerstone of its investment-grade status. This resilience is best summarized by the low net debt funds flow ratio of 1.0x. This metric confirms that, despite significant capital expenditures used to drive growth, the company maintains a conservative and highly secure balance sheet profile. Analysis of the market valuation suggests a compelling disconnect between the company's intrinsic value and its current trading price. Intrinsic value models estimate that WCP is currently undervalued by a significant margin of 41%. This valuation anomaly is reflected in the strong support from the sell-side community, which maintains a strong buy consensus. The average analyst target price of CA 1387 implies a substantial potential upside exceeding 32% from current trading levels. The confluence of a powerful operational growth story, low financial leverage, and a clear undervaluation signal makes WCP an attractive opportunity. 1.3. Key risk factors. While the investment case is fundamentally strong, two primary risk factors must be actively monitored. The most immediate financial exposure stems from commodity price volatility. The projected $1.2 billion FFF for 2026 is inherently reliant on the $60 WTI price assumption, meaning that the discretionary portion of capital, specifically the $300 million allocated to buyback/debt reduction, is highly sensitive to fluctuations in global oil prices. A structural risk is WCP's environmental, social, and governance profile. The company carries the severe ESG risk rating of 49.91. A rating above 40 is considered severe. This high rating, which is primarily related to carbon in own operations, Scope 1 emissions, poses a material barrier that may limit the addressable pool of institutional capital, particularly from funds mandated with strict ESG criteria. Addressing this structural risk through improved reporting and demonstrable emissions reduction will be key to unlocking further long-term institutional investment. IV, Corporate and Operational Profile, Momentum and Efficiency. 2.1. Q3 2025 Operational Review, Record Volumes and Netback Improvement. The third quarter of 2025 served as a definitive marker of Whitecap's successful integration strategy, delivering record operational metrics. Average daily production reached 374,623 barrels of oil equivalent per day, BOE per D. This performance represents a dramatic 116.1% increase compared to the 173,302 BOE per D produced in Q3 2024, confirming the effective scalability and rapid assimilation of acquired volumes, particularly following the Varen asset integration. Despite a challenging commodity price environment where the average realized price slipped to $48.17 per BOE in Q3 2025, down from $55.88 in Q3 2024, the gross petroleum and natural gas revenues surged to $1.6 billion. The successful incorporation of acquired assets, combined with aggressive operational streamlining, is generating permanent structural savings. Operating costs decreased by 8% to $12.50 per BOE in Q3 2025. This reduction validates the initial promise of operational synergies and establishes a low competitive cost floor. The ability to realize sustainable cost control directly translates into higher operating netbacks, which structurally lowers the corporate break-even price. This strengthened margin profile significantly enhances the security of the sustainable dividend base and de-risks the ambitious forward guidance against moderate shifts in commodity prices. 2.2. Asset performance and premium portfolio focus. Whitecap is characterized by its strategic concentration in premium high-return unconventional assets within the Western Canadian Sedimentary Basin. Its development programs are focused across high-value regions including Northern Alberta, Central Alberta, British Columbia, and Saskatchewan. Crude oil is identified as the primary revenue generator within the company's product basket. A standout operational achievement in the quarter was the performance of the core Montney assets, specifically at Gold Creek and Carr, which exceeded forecasts by 4,000 BOE per day. This outperformance was not driven by increased drilling intensity, but rather by optimization efforts, including the refinement of gas lift systems and improvements to gathering infrastructure. This technical superiority validates the inherent quality of WCP's underlying asset base and the management team's capability to achieve high performance through operational execution, confirming the long-term potential of these reservoirs. The company's strategic capital allocation reflects this focus. The 2026 capital program is heavily weighted toward unconventional assets, with 75% of capital directed toward the high-return Montney and Duvernay formations. 2.3. Forward guidance and growth trajectory. The operational momentum observed in Q3 25 prompted management to raise its full-year production outlook for 2025 to an average of 305,000 BOE across the year, up from earlier expectations. Fourth quarter production is specifically projected to reach approximately 370,000 BOE. Looking into 2026, the approved capital budget of $2.0 to $2.1 billion is highly disciplined. This budget targets an average annual production rate of 370,000 to 375,000 BOE, with liquids accounting for approximately 60% of the total mix. A crucial metric is the anticipated exit rate for 2026, which is expected to exceed 380,000 BOE. The capital expenditure strategy demonstrates a material improvement in capital efficiency. The company lowered its initial 2026 capital projections from approximately $2.6 billion to the currently approved $2.0 to $2.1 billion, yet maintained robust production targets. This ability to achieve the same or greater output with significantly less input capital, a saving of nearly $500 million, is a tangible demonstration of management's capacity to convert operational synergies into reduced required capital. Specifically, this saving is linked to the $130 million capital component of the realized synergies. This reduction in capital intensity is directly responsible for translating a larger proportion of generated funds flow into discretionary free funds flow, FFF, thereby supporting the elevated shareholder return program. IV, Financial Performance and Balance Sheet Analysis. 3.1. Funds flow and free funds flow generation. Whitecap's financial strength is anchored by its cash flow generating capacity. Q3 25 funds flow approached $900 million, $966.7 million, which successfully covered $546.3 million in capital expenditures, leaving a free funds flow of $350.3 million. Cumulatively, for the 9 months ended September 30, 2025, funds flow totaled $2,055.7 million, with total FFF reaching $702.5 million. The forward projection for 2026 solidifies this capacity, targeting $3.3 billion in total funds flow. Based on the assumption of $60 WTI, management forecasts robust free funds flow generation of $1.2 billion for the year. This consistent and accelerating FFF generation provides the necessary funding stream for both sustaining operations and executing the company's aggressive capital return strategy. 3.2. Capital structure, leverage, and liquidity. The company maintains a strong and highly conservative capital structure, critical for weathering cyclical downturns typical of the energy sector. Net debt was reported at $3.3 billion at the end of Q3 2025. However, the crucial metric of financial safety, the net debt to funds flow ratio, remains exceptional at 1.0x. This low leverage profile is indicative of an investment-grade financial posture, allowing Whitecap to maintain financial flexibility and pursue strategic growth without compromising balance sheet integrity. The balance sheet is further strengthened by $1.6 billion in available liquidity and a moderate total debt-to-equity ratio of 32.7%. This combination of low leverage and high liquidity provides management with the operational freedom to pursue a counter-cyclical capital allocation strategy. The company is positioned to maintain both strong defensive capabilities, securing the dividend and reducing risk, and offensive capacity, remaining agile for potential accretive M&A in future market dislocations. 3.3. Strategic tax shield advantage. Whitecap possesses a unique structural financial advantage in the form of substantial tax pools, totaling $9.8 billion as of Q3 2025. This massive tax shield, which includes $4.4 billion in non-capital losses, significantly protects the company's operational cash flow from immediate taxation. This tax advantage is material to the FFF generation forecast for 2026. Management projects that income tax expenses will be limited to approximately 4% of pre-tax funds flow. By sustaining such a low effective tax rate, Whitecap preserves capital that would otherwise be remitted as taxes, directing nearly all generated operational cash flow toward reinvestment, debt reduction, or shareholder returns. This preservation of capital ensures that the $1.2 billion FFF target is highly robust and predictable, increasing its quality compared to peers facing higher taxation hurdles and providing a significant internal buffer against potential commodity price volatility. IV. Resource sustainability and reserve metrics. 4.1. Total proved plus probable 2P reserves and longevity. The long-term value proposition of WCP is fundamentally underpinned by the depth and longevity of its resource base. As of year-end 2024, company share, gross, total proved plus probable 2P reserves totaled 394,366 MBOE, supported by total proved 1P reserves of 293,761 MBOE. This extensive reserve base translates directly into an impressive reserve life. The total proved plus probable reserve life index, RLI, is calculated at a long-dated 18.7 years. This RLI places WCP among Canadian E&Ps with profound resource depth, indicating inherently low corporate base decline rates. A lower decline rate minimizes the sustaining capital structurally required just to maintain production levels, thereby maximizing the FFF generated per baffle. This profound resource life minimizes decline rate risk and inherently supports a premium valuation multiple compared to short-life high-decline peers. 4.2. Reserve replacement ratios, RRR, and accretive growth. Whitecap's reserve replacement metrics confirm the high quality of its growth strategy. In 2024, the company replaced 154% of its production on a total proved plus probable basis and 123% on a total proved basis. Examining the long-term trend, the 3-year weighted average TPP reserve replacement ratio stands at an exceptional 380%. This high figure is a definitive indicator of management's proven capability to execute both successful organic drilling programs and accretive strategic M&A. This high-quality growth is demonstrably focused on shareholder returns. Management has consistently achieved a 13% CAGR in total proved plus probable reserves per share. This confirms that the growth is disciplined, explicitly increasing the intrinsic value attributed to each outstanding share, and distinguishing WCP from companies whose growth is achieved at the expense of per-share metrics. 4.3. Future Development Capital. The long-term development commitment is formalized by the future development capital necessary to fully monetize the resource base. The undiscounted FDC for the 2P reserves totals $8.37 billion. This substantial figure provides transparency regarding the long-term capital allocation required for full reserves capture and maintains investor visibility into the company's deep inventory of future drilling opportunities. V. Capital allocation strategy and shareholder returns. 5.1. Maximizing synergy impact on FFF. Whitecap's capital strategy is predicated on the financial uplift generated by strategic integrations. The forecasted annual synergies have been raised to $300 million, representing a 40% improvement over initial estimates. These synergies are structurally embedded into the 2026 financial model, promising long-term margin expansion. The composition of the $300 million is critical, confirming operational visibility. $130 million is derived from capital savings, e.g. rig line optimization, $135 million from operating cost savings, e.g. procurement initiatives and infrastructure utilization, and $35 million from corporate savings. This granular breakdown reinforces management's command over its cost structure and confirms that the synergies are material and sustainable, directly contributing to the elevated FFF targets. 5.2. The 2026 FFF allocation model. The company provides a highly transparent, prescriptive plan for allocating its projected 2026 funds flow and FFF based on $60 WTI. This framework prioritizes maintaining a strong balance sheet, fully funding the growth capex, securing the base dividend, and then returning remaining FFF through variable means. The $3.3 billion in forecasted funds flow is first directed toward the $2 to $2.1 billion capex program, resulting in $1.2 billion of FFF. This explicit allocation of 100% of forecasted FFF demonstrates disciplined capital management. The transparency of this model reduces execution risk for investors, allowing for greater precision in modeling returns based on their own commodity price assumptions. Furthermore, if commodity prices average above $60 WTI, the resulting surplus cash flow would augment the $300 million variable allocation, offering leveraged upside in the form of increased NCIB or accelerated debt reduction. 5.3. Return of capital commitment. Shareholder returns are prioritized through a dual mechanism of a sustainable base dividend and aggressive share repurchase program. The annual dividend of $0.73 per share, distributed monthly at $0.0608 per share, is highly secure. Management has explicitly confirmed that the dividend is fully funded at low commodity prices, underscoring its long-term sustainability, a confidence level derived from the company's low operating cost structure. To actively combat the persistent market undervaluation, Whitecap announced a $300 million normal course issuer bid, targeting approximately 2% of outstanding shares. This commitment confirms management's view that the stock is trading significantly below its intrinsic value. The NCIB acts as a mechanism to capture value on behalf of shareholders while simultaneously boosting per-share metrics, serving as a primary internal driver for closing the valuation gap. 6. Valuation and market positioning. 6.1. Peer group comparative analysis. Whitecap's valuation metrics present an investment case defined by potential for re-rating. The current PE ratio of 13.7x is mixed in peer comparisons, suggesting a need to analyze quality metrics. While one comparison places WCP favorably below a peer average of 15.4x, another analysis notes WCP is currently above its peer average of 11.1x. However, quality-adjusted metrics affirm the value proposition. WCP's price-book ratio of 1.1x is significantly lower than its peer average of 1.6x. This metric implies the company is trading at a discount relative to the substantial equity invested in its asset base, potentially signaling market underappreciation of its long-life reserves. The estimated fair PE ratio of 15.4x validates that the current PE of 13.7x suggests a degree of undervaluation relative to the company's justified growth and structural risk profile. The superior 18.7-year 2P RLI and favorable price-book ratio suggests WCP possesses a higher quality, longer-life asset base, which justifies a potential premium valuation segment relative to short-life peers. 6.2. Intrinsic value and market misalignment. Independent valuation models estimate the intrinsic value of WCP at 17.53 CAD, suggesting the stock is undervalued by 41% relative to its current market price of approximately $10.27. This wide disparity strongly implies that the market has not yet fully capitalized the value derived from the successful integration and the confirmed $300 million in structural synergy capture. The stock is currently priced as if the execution risk were higher than warranted by the financial results and forward guidance. As the company consistently delivers on its highly quantitative 2026 targets, the valuation gap is expected to close, providing substantial capital appreciation. 6.3. Analyst consensus and price targets. Wall Street analysts maintain a highly positive outlook, reflected in an overall strong buy consensus. Out of 16 polled analysts, 15 have buy ratings and only 1 maintains a hold rating. The high conviction is solidified by the average 12-month target price of CA $13.87. Based on recent trading levels, this average target implies a potential upside of 32.36%. The price target range narrowly clustered between a low of $13.13 CAD and a high of $15.75 CAD reinforces the general confidence in the company's operational trajectory and its ability to achieve its financial projections. 7. Risk assessment and sensitivity analysis. 7.1. Commodity price exposure and hedging. Whitecap's scale dictates that its financial performance is highly leveraged to fluctuations in global commodity prices. The discretionary capital tranche, the $300 million designated for share repurchases or debt reduction, is particularly sensitive to WTI price volatility, as the FFF projection is dependent on the $60 WTI floor. While Whitecap's strategy maximizes upside exposure in a high-price environment, the lack of detailed current hedging disclosures suggests a high reliance on volatile spot prices, increasing downside vulnerability during unexpected market corrections. Mitigating this risk is the company's superior, structurally improved cost curve. The high operational efficiency, confirmed by the 8% reduction in operating costs to $12.50 BOE, means Whitecap reaches its operational break-even point significantly later than its higher-cost peers in a downturn. This superior cost base acts as the primary organic defense mechanism against adverse price movements, ensuring the financial security of the base netback and providing a high degree of confidence in the sustainability of the $0.73 per share dividend. 7.2. ESG and regulatory risks. A structural challenge for Whitecap, common to the energy sector, is its ESG profile. The company carries a severe ESG risk rating of 49.91. This high rating creates a critical hurdle for attracting capital from institutional funds with specific ESG mandates. The most material issues driving this rating are carbon in own operations, Scope 1 emissions, occupational health and safety, OHS, and emissions, effluents, and waste. The severe ESG rating likely contributes to the stock's persistent undervaluation, acting as a non-financial constraint on its valuation multiple. However, demonstrable, substantive improvements in addressing these key material risks, particularly Scope 1 emissions reduction, could unlock a non-financial catalyst for the stock. Addressing these concerns could broaden the investor base and facilitate a significant market re-rating, further closing the 41% intrinsic value discount. Furthermore, like all Canadian E&P companies, WCP is exposed to regulatory risks from evolving Canadian climate policies, such as carbon taxes, which could mandate additional compliance capital expenditures, potentially eroding future FFF estimates. 8. Conclusion and investment recommendation. 8.1. Investment summary. Whitecap Resources Inc. has effectively leveraged its strategic M&A activity, resulting in superior operational momentum validated by record Q3 2025 production and confirmed structural cost efficiencies. The forward view is exceptionally well defined, guided by a disciplined $2.0 to $2.1 billion capex program, robust growth targeting 370 to 375,000 BOE per day in 2026, and a transparent financial commitment to return capital through a $1.2 billion FFF allocation plan. The company's low financial leverage, 1.0 net debt/FF, provides investment-grade safety, while its long-life resource base, 18.7-year 2P RLI, ensures durability. The current market undervaluation, coupled with strong sell-side conviction and the pending realization of significant synergies, presents a compelling opportunity. The investment thesis hinges on the successful realization of the $300 million synergy uplift, which fundamentally elevates WCP's long-term free funds flow profile and permanently improves its capital efficiency. The stock offers an attractive combination of income security derived from a sustainably funded base dividend and significant capital appreciation potential, supported by an implied upside exceeding 32% to the average analyst target price. WCP is optimally positioned to be a core, high-quality holding for institutional portfolios seeking per-share growth within the Canadian energy sector.